Let us now focus on the pros and cons of the internal rate of return as a measure of financial attractiveness of the project. Okay, it looks like it is a very elegant and nice way to measure financial attractiveness with internal rate of return, because what is needed is just the IRR of the project, which is compared with the cost of capital. Well, unfortunately, it's not so easy because there are certain drawbacks connected with the use of internal rate of return, and I want us to discuss them briefly right now. Okay, so the first problem with internal rate of return is that it is a relative measure. Okay, relative, it means that it completely does not take into account the size of the project. So as a matter of fact, you can have smaller size projects with great internal rates of return. If those projects can be scaled up, in fact, the value for shareholders in such projects may be lower than in the greater project with lower NPV. Okay. Also, it in fact means that there might be projects which have higher internal rate of return and lower NPV. Okay, so when you compare internal rate of return with NPV, you will notice that NPV is in fact a measure of absolute return. Okay, and in all cases, NPV should be given priority. Okay, to put it another way, it is the goal of the financial managers of the company to maximize NPV of the projects, not to maximize internal rate of return. And just to give you an example of what I'm talking about, I will show you two projects which I included here in this spreadsheet. Let's assume that the company is considering two investments. Okay, there's project A and project B. The company has just sufficient capital to invest in one of those projects. They cannot invest in both of them. Okay, both projects require exactly the same initial investment, which is 1,000. Okay, and the difference between these projects is that project A is much shorter and provides a greater cash return in each of the 5 years. Okay, project B is much longer. Okay, I don't know how many years. Okay, but definitely much longer than project A, and it only offers 150, but for a greater number of future periods. Okay, what I have here is that I calculated the NPV. Okay, in this case, I used the NPV formula to calculate that of the two projects. Okay, and as you can see, NPV of project B is higher than NPV of project A. Then I calculated the internal rate of return of both projects, and as you can see, project A has a higher NPV. Okay, so if the management believes that the cash flows proposed in the cash flow schedules of those two projects, well, they will appear in the future. Obviously, the management should opt for project B because it has a higher NPV despite having a lower internal rate of return. Okay, this is not the only, the fact that IRR is a relative measure of relative return is not the only potential problem with the internal rate of return. The second issue that I want to present to you is the fact that not for all investment projects, the relationship between the internal, the NPV and the cost of capital can be shown with such a line. Okay, as a matter of fact, some investment projects have quite complex schemes of cash flows. Okay, so there are in fact situations where mathematically there is more than one solution to the NPV equation. Okay, if projects are simple, okay, what I mean by simple project is just the project for which we calculated this NPV and IRR here. Okay, so simple in the sense that in the beginning I have a negative cash outflow, the initial investment, and then it is followed only by positive cash returns in the following years. Okay, for such projects, okay, let me graphically show them here. Okay, I have a negative cash flow and then a series of positive cash flows. Okay, if I have a project like this, then for such projects, the relationship between NPV and the cost of capital is going to look like that. Okay, so we're just going to have one internal rate of return, and the economic interpretation of this internal rate of return is very simple. I mean, if the cost of capital is lower than the internal rate of return, then obviously you've got an NPV positive situation. Okay, but if you have more complex projects, for example, imagine a project which requires an initial investment in the beginning. That's the case for most of the projects. Okay, and then it has a series of positive cash flows, but then when the project is ended, again I don't want to say cash investment, but a negative cash flow is required for that project. Then in fact there are going to be two internal rates of return for that project. Okay, so the NPV function in relation to the discount rate will now look something like that. Okay, so I'm going to have one IRR, IRR1, and another one here, okay, IRR2. Yeah, so what the problem with this is, well, clearly I have no problems with explaining what internal rate of return 1 is. I mean, obviously, for this internal rate of return 1, the interpretation is pretty much the same as in the picture above, okay, but there is a problem with this IRR2. Okay, it doesn't make any economic sense. I mean, it's obviously absurd to think that when the cost of capital is just sufficiently high, the NPV of the project will start increasing again. I mean, that is not true. Okay, so this cannot be explained. Okay, so just to sum up, while internal rate of return is a very useful measure, it is not, maximizing internal rate of return is not the goal of investment appraisal exercise. Maximizing NPV as the measure of absolute return is the goal. Okay, despite the drawbacks of internal rate of return, which I have just listed, fortunately or not, there's plenty of places in the financial markets where you can observe internal rates of return, or when the internal rates of return are quoted to you as investors or to you as finance professional. Okay, one example of an instrument where internal rate of return is commonly used is debt instruments, namely bonds. Okay, of course, we will talk more about bonds when we talk about how companies finance their operations. Okay, about debts and equity and all issues related to the choice of the capital structure. Okay, but for now, we can just look at a simple example of a bond. Okay, and a bond is a debt instrument, meaning that when it is issued, the issuer of the bond, okay, or the debtor receives the money that is paid in the marketplace by the investors, by the bondholders, and at the same time the issuer promises to the investors to pay out certain interest called coupon for a certain amount of time until the bond is matured. Okay, so let's assume that we have a bond here that has the annual coupon of, say, 5% on the nominal amount of, let's say, 100 euros. Okay, and the maturity of the bond is going to be 5 years. Okay, so if you have a bond like that, it means that whoever purchases this bond in the marketplace will be entitled to receiving the following coupons. Okay, 5% on 100 is 5 after year 1, 5 after year 2, 5 after year 3, 5 after year 5, 5 after 5, sorry, after year 4, and 5 after year 5. And in addition to that, after year 5, the bond is going to be redeemed at its par value or nominal value equal to 100. Okay, and now if this bond is traded in the market, its price is going to change. Okay, so let's assume that you receive information that the yield on the bond, yield, or sometimes called yield to maturity, or the YTM of the bond, equals to, let's say, 6%. Okay, what does that mean? How can this be interpreted? Well, this yield, or this yield to maturity, is nothing more than the internal rate of return on this bond, which is calculated for those contractual cash flows which were promised in the letter of issue of the bond, okay, and discounting those amounts to the price of the bond. Okay, so there's a price that has to be paid for this bond in the marketplace. Okay, and then 6% is the yield that the investor who decides to buy this bond will achieve if they decide to keep this bond until maturity. That's why it's called the yield to maturity. Okay, so how is it possible that the yield of maturity, or this internal rate of return, is now higher than the coupon rate? Okay, if it's higher than the coupon rate, it means that the price on this bond must be less than the par value. Okay, so less than 100. Okay, and the price is such that the internal rate of return equals to 6%. Okay, we can solve this exercise to find out what this price would have to be, and think about it in terms of the relationship between the internal rate of return and the price of the bond. Okay, so let's go to the spreadsheet again, and let's type in the numbers relating to that bond. Okay, so here we will have the contractual cash flows on the bond. Okay, maybe I'll just make it a little bit bigger so that you can see what's happening here. So here I have time, okay, and it's from 0 to 5, okay, 5 years. Here I have the cash flows, okay, so in year 1 it's going to be 5, then 5, then 5, then 5, and here 105. Yeah, so of course the question is, what is the value if the internal rate of return is 6%? Okay, we know what internal rate of return is. Okay, internal rate of return is the rate that discounts all the future cash flows of an investment to the negative cash flow needed at the beginning, the initial investment. In this case, if you want to get access to this 5 and make the 5%, make the 6%, then you need to pay something less than 100. Okay, let's see what the internal rate of return is if the price was 100. Okay, so at the price of 100, okay, I'm going to substitute the 6% with the internal rate of return function now. Okay, the internal rate of return is exactly 5%. I mean, this is obvious. I mean, you invested 100 and then you get 5% on this 100 for 5 years, plus you get back the initial 500. Okay, but when I start decreasing this price, okay, let's say I put in 99, okay, for 99 not much changes unless I add some more decimal places. Okay, when I change the price down from 100 to 99, I see that the internal rate of return, okay, actually goes up. Okay, so at 100 I get 5%, At 99, I get 5.23. At 97, I get 5.71, and so on, and so forth. Okay, so obviously I can either use trial and error to find out what the price should be if I want to have here exactly 6%, okay? Or I want to do, or I can do something else. I can do something opposite. I can discount all the future cash flows using the internal rate of return of 6% and see what price I get. Okay, so let's solve it now. Okay, let's we know that the internal rate of return or the yield is 6%, and I will discount all those cash flows at 6%. Okay, so I'm adding the discount factor here, and the discount factor is 1 divided by 1 plus 6%. Okay, again, I'm fixing this formula. Okay, I'm raising this fraction to the power of 1. Okay, and I get the discount factor, okay, with 3 decimal places. It's this. I mean, obviously, I could also use the present value table to calculate that. Okay, so here I have the discount factors, and I can compute the present value. Okay, so here are present values of all those cash flows. Okay, and now the price of this bond is going to be the sum of the present values. Okay, so if I calculate, if I add all those present values, I get 95.79. I'm giving it a negative sign, a minus, so that it corresponds with the price that would have to be paid for this bond right now. And as you can see, the internal rate of return calculated at this 95.79 gives me exactly 6%. Okay, as a matter of fact, there are plenty of bonds and other instruments out there for which the prices are not given, but what is given is just this yield to maturity. Okay, so by using this yield to maturity and applying it to the contractual cash flows of the instrument, you will know what is the price of that instrument in the marketplace at a certain moment, moment in time. Okay, one more thing, and the last thing I want to tell you about the yield to maturity on a bond. Why does it change? Why the price on the bond is going down from 100 to 95.79? Well, actually, it is because the conditions in the marketplace change and the required rate of return of the investor is going up. Okay, so if the required rate of the investor is going up, for example, because the central bank has just increased interest rates and now investors want more return on all the investments, okay, what cannot change in such a situation are the cash flows, okay, because the cash flows are fixed. A typical bond is a fixed income instrument, fixed coupon instrument. Those coupons of 5 are 5 from the beginning, from the issuance until the maturity of the bond. Okay, so if you want to have this bond and make more money in the marketplace, what has to change is the price, and the price will keep on changing, will keep on going down until the yield, the return of the bond reaches what the market expects, which we assumed here in this case to be 6%. Okay, another explanation that we could provide here is why actually investors, why is this price really going down or going up? Okay, just imagine that the required rate of return of the investment was 5% for that bond, because this is what the market consensus was. This is what the people in the marketplace expected. They wanted 5%. Okay, and then sometime after that, the central bank increases the interest rate. Okay, right now, the angle at which investors look at instruments in the marketplace is just slightly different. Now they want more. Now the reality is that they can expect 6%. So imagine you bought the bond, you have this bond, you paid 100 for it, and now you want to get rid of it. You want to sell it in the market. Why? Well, for example, because you want to buy a new instrument which will bring you 6%. Unfortunately, you will not be able, or nobody will be willing to purchase that bond from you at 100. Why? Because it only promises this 5, 5, 5, and 5. So in fact, if you want to find a buyer for this bond, you need the price of this bond to go down, okay, up or down to the level at which this bond is promising or is offering the yield to maturity equal to what is required in the market. Okay, so this short exercise with the bond was here just to give you an example of a real life situation where internal rates of return are quoted in the marketplace. Of course, when it comes to bonds, there will be more videos about debt instruments and how companies issue different types of bonds to finance their activity.